What's up everyone, it's Kadi with MoneyVest. So in this video, we are going to be talking about and answering the question, is this time different? Because as we know that the markets have obviously been very strong in 2023, and there's been a lot of concerns over a potential recession in 2023 or 2024, and we still haven't seen that. Some people argue the recession is already here, we're living it. Some people argue that it came and went already. Some people argue that it's actually going to happen in the future. I'm here to settle that debate. It's going to be an ongoing debate, so there's no way for me to settle it for good. But to give you a little bit of an idea on what I believe is happening at the moment and what could potentially take place in the future. Again, this is in no ways a prediction. I'm not making a prediction here. I'm just trying to assess the current situation and try to understand and kind of give you a little bit of an insight on what I believe could transpire if certain events play out in certain ways. So I hope you guys enjoyed this video and find it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel. This right here is going to be the starting point. And we have looked at this multiple times over. This is simply the spread between the 10-year and the 2-year yield. Okay, so this is the 10-year bond minus the 2-year bond, and if this is negative, in other words, the inversion of the yield curve, right? So the yield curve is currently still inverted, and the spread is negative. Every time that's happened, we have seen the economy, of course, put into a recession. In other words, we have dipped into a recession every time this yield curve has inverted and the spread has turned negative. The last 4 times, it's got 100% success rate, and this right here is the massive inversion that we have witnessed in 2022 and 2023 as the yield curve continues to remain inverted as well. In the last 1 month, you'll notice that we have once again rolled right back down. So we were actually very close. We were very close to pushing back above the 0% level. In other words, uninverting, as we talked about for most of October. But in November, we are starting to roll right back down, and we are negative 48, 49 basis points once again. Now, one of the things that I mentioned in my previous videos was it's not until the uninversion takes place that the recession basically starts, or the unemployment starts to go up. As you can see on these charts, and these are absolutely picture perfect, that this right here is the inversion of the yield curve, and when the spread starts to turn positive again, in other words, when we see that uninversion take place, the blue line is the unemployment, okay? The unemployment rate also starts to go up, right? So we are basically consolidating sideways here inside that blue line you can see, and then as soon as the uninversion starts, the yield curve starts to uninvert, or the spread starts to turn positive. As you can see, the chart is going up, the unemployment also starts going up. And they are so well correlated. You can see they're both going down at the same time. Over here, you can see that we obviously turn negative once again for the spread. And look what happens. We start to uninvert, and the unemployment rate also starts to move up. That's the blue line you see on the chart. Same exact thing happens here. So we are once again below 0%. We are looking at negative spreads. And then when it starts to uninvert, look what happens to the unemployment. Basically a huge spike in unemployment. This was in 07, 08. This right here was during COVID. Again, you can see the both of them moving in the same direction. Uninversion happening while unemployment spiking during COVID as well. Now, what we have really witnessed is nothing really, right? And this is the question, is this time different? Is this time going to be the time where we do see the uninversion, we do see the spread turning back over to the positive territory, back over 0%, while unemployment staying really low and muted and not really following the uninversion of the yield curve or the spread? That's the question that we're here to discuss, and I'll go over some of the reasons as to why this may be happening and why the economy continues to be extremely resilient with low levels of unemployment and, of course, very high levels of productivity, and the economic growth continues to be pretty strong. So this right here is going to be the unemployment rate with, I believe, the delinquency rates. And you can see a very similar pattern, which makes a lot of sense because every time we see a recession, delinquency rates basically spike, and then every time we're seeing economic growth and these spreads are coming down, we see the delinquency rates come back down, because that's usually the time when the Federal Reserve is also cutting interest rates. But both of the times you can see a huge spike and uninversion of the yield curve, we see the delinquency rates on the rise. And this right here is going to be 07, 08, uninversion taking place, and a huge spike in delinquency rates, basically people not being able to pay or service their debt. And right now, once again, you'll notice we are seeing some levels of uninversion, but the delinquency rates continue to be really, really low at less than negative 0.1, negative 1 to negative 2%. And we're nowhere near close to the levels that we have witnessed before. This is all consumer loans. Doesn't matter what it is: credit cards, mortgages, auto loans, personal loans, student loans, everything. So all put together, and through commercial banks. And you can see 0708 was obviously a pretty majestic time when delinquency rates were as high as 6.5, closer to 7%, which again, in the grand scheme of things, is a pretty big number if you think about it that way. Now, this right here is oil prices. And one more thing I want to mention here is when oil prices rise, right, eventually a recession follows. So you can see that every time oil prices have gone up, this right here is the increase in oil prices. What happened? Recession followed a few months later. This right here is the incredible increase in oil prices, and this was the continuous increase in oil prices. I believe you're going back as far as 2007, 2008, of course. Basically, this right here is the entire move in oil prices. What happened? Recession basically followed a few months after. This right here is, once again, the oil prices going up, and you can see a pretty significant spike. This is also due to COVID, right? So we have to take into account why we dipped into a recession in 2019, 2020. But right now, once again, you'll notice oil prices on a very, very remarkable rally. They have been elevated. They've been over $70, $80, $90 a barrel. And yet we've got the unemployment rate sitting really, really low, extremely low levels. And quite honestly, very strong, right? We've got a very strong labor market in the US, where the economic growth continues to be very strong. So again, this begs the question, right? Is this time really different? Is this time really the time where we're seeing all the indicators suggesting for an economic recession, and yet there is none? Okay, I want you guys to comment down below as well. And before you do that, I also want to mention our Discord and our Patreon. There is a 16% annual discount that's available until the end of this month. I would really appreciate it if you guys check that out. You get access to 40 plus private videos, members only videos, trade ideas, discussion channels on Discord, 20 plus channels, including our Excel spreadsheets and members only videos. And also I want to mention that we've got our courses currently on sale. 50% to 60% off for Thanksgiving. So these are educational courses, lifetime access, and everything that I add on to these courses over time, like all the videos, you're going to have access to them for free. And over 120 plus lectures with 30 plus hours of content. Coupon code is going to be Thanksgiving. And the best part is that your family enrolls for free. So once you are enrolled, you can share that with your family members as well. And again, these are all the 4 courses that we have: fundamental analysis, technical analysis, options, and psychology as well. And then finally, TradingView also has a pretty big sale for Black Friday, 70% off. So this is literally the holiday week, holiday season, and you can find really good deals for both TradingView, for our courses, and for Discord and Patreon as well, where we're also giving 16% annual discount if you do join before the end of this month. So just wanted to put that in there. Definitely do check that out. Now going over to the companies, right? So now there are even fewer companies discussing recession on their earnings call for 5th straight quarter. So this right here is going to be that chart, which basically shows that we are seeing a pretty significant dip in the number of companies that are mentioning or citing the word recession in their earnings call. You'll notice that in the past, when this has actually spiked, we have seen a recession. This only goes back as far as 2013. But if you go back further, we have seen pretty significant spikes in 2001, 2000, 1990s, and in 2007, 2008, because companies and their management and the C-suite, more specifically, has a very good idea on what's going on with the supply chains, have a very good idea on what's going on with demand, with supply, with inventory levels, with spending, with consumer behavior. And those are some of the very important leading indicators to better understand whether the economy is going to start going into a bit of a decline or a contraction, or if this growth is going to continue. So they are a very good leading indicator, right? And it's surprising that they are now seeing fewer companies cite a quote recession in the earnings call. And I think part of the reason is because how strong consumer spending has been, right? And consumer spending now has been stronger on the back of debt and not on the back of savings, which is exactly what I'm going to go over later in the video. But if you take a look at number of companies citing the word recession in their earnings call, a lot of them are financials, industrials, and real estate. And percentage-wise, real estate, financials, and industrials. So those are the 3 sectors that are still concerned and talking about a potential recession. Other sectors, not so much. They're kind of brushing it off. They're like, yep, it's not going to be there. We're not worried about a recession or whatnot, but they're not mentioning it as much as before. Now, this right here is markets' bets for Federal Reserve policy easing next year, and they are expecting for significant cuts, around 75 basis point cuts. And the interesting thing is that we now flipped again. We are now looking for a sooner cut in May of 2024, being the first cut starting in May. So in less than 6 months is what the market's pricing in, that we're going to see the first cut from the Federal Reserve, and that's going to continue all the way through December of next year with 4 cuts priced in with almost 100 basis points. That's going to bring us down from 5.25%, 5.5% to 4.25 and 4.5%. So that's really what the market's expecting, which does open us up to a huge amount of repricing risk, because if there is no cuts in 2024, and what Jerome Powell and the Federal Reserve has constantly reminded us of, that we're not looking at cutting rates, then the markets will be looking for repricing whatever information is available to us at the time. But right now, market's very optimistic and bullish on the idea that there's going to be 4 cuts in 2024. Okay, so how does this all play out? Okay, here's the summary and here's the key conclusion that I've arrived to in my notes. So Ray Dalio mentioned, and I would fully agree with him, that there was a lot of transfer of wealth from the public sector to households and the private sector, right? And households and private sector being private sector as in consumers, and households and businesses. So there was a lot of transfer of wealth during that time, during COVID times, during stimulus checks, and a lot of PPP loans, and a lot of just quantitative easing resulted in the balance sheet of both consumers and households and businesses to be very, very well capitalized. Okay. We've looked at the savings rate, it spiked over 30% during the pandemic, and then it's now back down to sub 2%. Businesses are continuing with those strong cash flows and earnings on the back of strong consumer spending, right? So when people and households were very, very well capitalized, what did they do? They obviously spent money, right? And when they spent money, obviously that's what's driving inflation higher. That's why we're doing higher interest rates to bring inflation down. Why did inflation go up in the first place? Because demand outstripped supply significantly. So private sectors started spending, and when they're spending, they're obviously giving their money to businesses, and businesses ended up being with very strong cash flows and earnings, and not only with the spending that the consumers were doing, but also through the transfer of wealth. So they basically had a double win during that time. Not only were they receiving all these quantitative easing benefits and really, really low levels of debt, like in terms of interest rates, so they were basically able to borrow at very, very cheap rates, but consumers were also spending, right? So they had a very, very strong environment to do well, and strong cash flows and earnings represented that. And as a result, right, when businesses are growing, you've got a very nice hiring sort of rally, and jobs are very strong and unemployment is low. That's exactly what we are witnessing right now. I think businesses and companies are well capitalized in a way that they're not under stress. They're not under, well, I guess there's a segregation that we need to make. We need to make that distinction that, okay, a lot of S&P 500 companies are well capitalized, right? They've got a lot of cash sitting on the sidelines. They're doing really well versus the smaller cap IWM companies that are dealing with floating rates of debt and that are not even profitable or not generating positive cash flows. So there is that distinction that we need to make. But for the most part, even private companies and small, medium businesses that are not publicly traded, even those companies are well capitalized, they're doing well, they're hiring right now, and unemployment continues to be very strong. However, debt levels are rising significantly, right? And as I mentioned earlier, consumer spending has mostly been strong on the back of debt, not on the back of savings, right? It's not like people are making money and they're making more money and they're spending more money. No, they're making the equivalent amount of money. Maybe they're making slightly more, but they're spending a lot more because of taking on debt, taking on credit card debt, taking on mortgages, auto loans, personal loans, whatever it is. And delinquencies are low because jobs are plentiful, right? That's why we haven't seen that breakaway scenario where, okay, debt levels are high, delinquencies are also going up because people are not able to pay that debt. No, debt levels are high, but delinquencies are still low because jobs are plentiful and people are still able to service that debt, at least for now. Okay, so the key piece that we need to focus on is how the consumer behavior shifts and how consumer spending ends up being. If people over leverage themselves, if consumers as a whole start to take on too much debt at a point where it becomes not manageable anymore, then we will start to prioritize what we need to spend money on, right? Where do we need to spend money on? And if that starts to happen, it's possible that delinquencies start to rise, right? So delinquencies and jobless claims are kind of like two things that kind of go hand in hand, because if delinquency starts to go up, right, people are not paying off their debt, they're not able to service that debt, And as a result, if companies are not making enough earnings or revenue, I'm kind of really making it very simplistic here. It's not that simple. It's very complicated. But if people start to not service that debt, delinquency rates go up. Company earnings are going to get affected, and as a result, if their hiring process and their unemployment levels could start to go up, which obviously could lead to even more pullback in consumer spending, economic slowdown, contraction, and as a result, high levels of unemployment and potentially rate cuts from the Federal Reserve, and that's obviously going to be bearish short-term, bullish long-term for equities. So that's where we are right now. It's we've talked about this before, but unemployment and jobless claims are some of the very, very important initial markers of a recession. And right now that continues to be extremely strong is what we are seeing from the economy. But the only way that's going to start to actually show signs of some cracks is if delinquencies start to go up, if unemployment levels, the only way they're going to go up is if companies stop hiring, right? Because they're still hiring and the jobs growth is very strong. If they stop hiring, why would they stop hiring in the first place? Is because they're not making enough money. The earnings are starting to slow down. They're seeing signs that there's a significant slowdown in spending and the consumer behavior is shifting as well. So those are some things to keep in mind. I wouldn't necessarily call this as that this time is different and we're out of the woods and nothing's going to go wrong and we are fine back up to all-time highs and the economy is good, because there's a lot of indicators that are suggesting that it's not. But then there's also a lot of indicators suggesting that it is, but the ones that are suggesting that it's not have slightly more weight than the ones that are suggesting that it is, because the ones that are suggesting that the economy is good are more like temporary factors and temporary indicators on the back of debt. But over the next 6 to 12 months, I wouldn't be surprised if the economy really starts to slow down and we see some type of contraction in 2024. So let me know your thoughts down in the comment section below. And hope you guys enjoyed this video, found it helpful. Make sure you drop a like. Don't forget, join our Discord and Patreon. Link's going to be down below. We'd love to have you on board. Again, courses are 50 to 60% off, our biggest sale of the year. Coupon code Thanksgiving. You get lifetime access to hundreds of lectures and videos and hours of content, including spreadsheets and PDF documents and all of my financial models. And again, Black Friday sale also going on for TradingView, and the coupon code for them, literally the link's going to be down below, 70% off. As always, happy investing. I'll see you all in the next video.